to this episode. Thank you for joining us. I'm Alex Massioli, my co-host Ryan Gorman, and we are joined by guests who have actually tried to have on many of times, done a lot of false starts on his calendar trying to schedule this. Co-founder and CEO of crypto fund Strix Leviathan, Jesse Proudman. Thank you so much for taking the time out, man. Really appreciate it.
Pleased to be here. Thanks for having me.
I heard about you a couple of years back. Your name came up in crypto circles, and all in positive ways, by the way, in case you were curious. But you do, and your firm does have a good reputation in the space, and it's one of those anchor funds you guys launched in April 2018. You're one, West Coast has its own hero fund, so to speak. East Coast has theirs, and then there's the rest of the world. But you guys have been there sort of right when the antithesis of the crypto hedge fund, boom, kind of came around. What I've learned about your business over those last couple of years is how dynamic it is. And I want to get into that. But first, what a lot of people, almost all of them, want to know is, how did a person go from the regular world into the crypto world in making a living? And I know your background, you actually weren't even from the financial markets per se before launching a hedge fund. So please enlighten us with this story, because it's cool.
Yeah, absolutely. I wish I could say I was from the regular world. I think I've been a lifelong entrepreneur, and so I think that disqualifies me from that statement. But my last company was called Blue Box. It was a cloud computing company. I founded it in 2003, bootstrapped it for 9 years, and raised about 22 million in venture, and ultimately sold that company to IBM in June of 2015. So we were a cornerstone of the IBM private cloud product line. So the first year and a half at IBM after the acquisition, I was working to integrate that product into the broader IBM cloud ecosystem. And then the last year, I found a role with IBM Ventures, and they wanted to launch an accelerator program. So Microsoft has Microsoft Accelerator, Google has Launchpad. IBM didn't have a centrally managed accelerator initiative. And so I started working with IBM Ventures to design that program. And this was sort of March, April of 17. And we got approval to get started on it. And my job over 2017 was effectively to research the blockchain space while we waited on funding to come in to launch that program itself. So I went from sort of distinguished engineer working on the IBM cloud product to being able to sit and research the blockchain space all day, every day, through probably its largest hype cycle to date. So it was sort of a fascinating time to be involved in that. Fast forward to Q4 of 17, IBM came back and there wasn't budget available to launch that accelerator program. And there was a role available for me to work on Hyperledger with a relocation to New Jersey. And as good as that sounded, I love Seattle. And so elected to sort of go out on my own and start thinking about something new. And I remember it was about, I'd been, from that research, had been staring at pricing charts and reading blogs and podcasts, Telegram, Twitter, sort of everything over 2017. And you stare at enough of these crypto charts after a while, and you start to feel like you can see obvious patterns, visual patterns in the charts. And I felt like if you could visually see these patterns and you can programmatically see these patterns. And so sort of nights and weekends in Q4, I started to pull together a prototype of software to pull down trading data off of exchanges, normalize it, store it, and look for patterns within that data. And I think it was 3 days before that 2017 all-time high at the end of December, and I felt like I had something that was working, and texted my current co-founder, now Sadie, and said, "Hey, I've got this crazy idea. What are you doing?" And we kind of came together and decided to give it a go. So we launched Strix Leviathan in January of 18, really with the thesis that the tooling available to sophisticated funds in this space was non-existent. That any of the funds that were largely trading today were doing so in spreadsheets using predominantly discretionary trading methodologies. And we felt like there had to be a better way. And based on my software background, knew we could build that software. And so the thesis on the launch of Strix Leviathan was to build sort of institutional grade quantitative software for crypto funds. And not knowing sort of which direction these markets would go, and if there were enough crypto funds to really make that a viable business long term, we elected to build our own asset management firm that would use that software for its vehicles. And so sort of the rest is history.
I mean, okay. So that was a lot. And being an entrepreneur is one thing. It has its own challenges. Trying to tackle a really nascent, new emerging market is a whole different story. And, there's a couple of different variants of Strix, that's come along, right? So you decided to launch a hedge fund. Without experience really in the market. So that's the first thing. But then also trying to conquer algorithmic trading based on the patterns. So you actually went down the road of creating a SaaS platform in order to try to monetize it, really at the beginning of the boom of the trading. Because to your point with spreadsheets, back then there was very rudimentary technology in order to keep track of pre-trade, post-trade, and everything in between. So between the asset management and the SaaS technology, which by the way you raised your own money for as well, one of them being from a famous football player's venture fund, Joe Montana, but which came first, or was it parallel to each other, or give us some clarity on how that roadmap was.
Yeah, they definitely were developed in parallel. The asset management side, we couldn't do without a platform. And the platform we couldn't develop without knowing the requirements of an asset manager. So it really was a symbiotic relationship. We did raise equity capital into the parent company, Strix Leviathan. We've raised about $2.83 million or so from Joe Montana's Liquid 2 Ventures, and Signum Capital, our two largest venture investors from externally. And so we put that capital into building the software platform, but we really, without having the asset management business, wouldn't have known what to build and wouldn't have been able to evolve what we started with to what it's become today. There are so many facets and components to successfully running an end-to-end fund like we're doing. And really the technology, the state of the technology in 2018 was absent. It's become a little better, but it's still incredibly fragmented. And so we've decided and we've determined for our own business that we needed an end-to-end platform that did everything from data aggregation to strategy development to strategy execution, kind of watching the data streaming and making trading decisions, trade execution, post-trade settlement, reporting, LP reporting. So all of these pieces, they're all tied together and interwoven. And to be operating in a business that is 24/7, 365, and that has the sort of the ferocity of speed, or I mean, these markets are crazy. When they move, they move. And to be able to respond and manage a vehicle appropriately in that environment, we felt like we needed full control of that technology stack.
You launched or started the firm in January and had the fund, I guess, in 5 months, right? Did you build all of that technology in that time frame that quickly, or have you built it over time?
Yeah, I mean, certainly it's a never-ending product. We in the first 4 months built we carried on from the prototype that I developed in Q4, and we used that to build the initial data ingestion, strategy development, and monitoring pieces. Trade execution was very rudimentary when we started. We got signals, and we went to Skype chat rooms to trade OTC. And it was stunning to me that was sort of state of the art in 2018.
Those were the days.
Yeah. You go into a chat room and say, I want to buy $1 million worth of Bitcoin to 4 different desks and sit there waiting for somebody to respond. Like, it was a wild world. So the system has evolved dramatically over the last almost now 3 years. And so as we've developed or as we've identified challenges or needs or issues, those have eventually manifested themselves into pieces of the platform. LP reporting is a great example, right? All funds in this space have to work with third-party administrators sort of legally to provide statements back to clients. That process to cut NAV to figure out what the fund was worth at the end of the month with a third-party administrator often takes 2 or 3 weeks at the close of the month. And that used to drive me nuts. Like, we should know the moment the month closes, what we made and what our investors have made. And so we ended up building an entire LP accounting system into the technology platform that tracks all of the same things that the TPA does, and effectively runs as a set of shadow books, right? The TPA is the true, accurate representation of the fund, but we're able to run our copy, and we get incredibly close to what those final TPA estimates are because we have that end-to-end platform, and we can do it sort of the moment the month closes. So, and that was a need that came up sort of 18 to 20 months into the operating the vehicle. So as we figured out problems and pain points and friction points within this space, we've ended up continuing to add on to the aggregate platform.
So I deal with hedge funds as my primary business. That's what I do, and I've done it for the last decade, and now the last 3 in crypto hedge funds. So when you guys launched, I mean, you launched at what's a good way to say it? An interesting period.
The worst possible time.
Okay, Jesse, I was trying to make it sound really poetic there. You launched at the worst possible time. Okay, you're a new fund to a space where even the most seasoned investors are new to this market and investing from a limited partnership standpoint. You know, how crucial do you think building those internal technologies were? Because one, let's talk about risk management, and let's talk about investor transparency. 2 vitally crucial things, even if you're Bill Ackman or Dan Loeb or any of those guys, here you are. I mean, one, you must have been so many steps ahead of the average crypto fund back then. But also investors must have just respected that so much more and been like, okay, from an educational standpoint, I kind of see what you guys are doing a little clearer than, say, the guy next door.
Yeah, so our launch was a fascinating sort of story in timing. It was incredibly fortunate in that we launched right at peak mania. We launched the company right at peak mania. So the equity capital we were able to raise to fund the development of our software platform, that process was a 6-week end-to-end process to raise our initial round. It's the fastest I've ever raised equity capital. People were just excited, right? It was a way for traditional venture funds to get exposure to the space that wasn't directly buying spot coin. So it was very easy to get that complete. Then the vehicles that we launched became available in April and May of 18, which was the worst possible time to launch. Because if you look at price action starting in May, it was just a straight line down into the end of the year. And a lot of the enthusiasm had already been sucked out of the room from all the volatility in Q1. So we found it very easy to raise equity capital and very challenging to raise fund capital. And it was very opposite from what I anticipated launching this business. But I think that's fine. I think it gave us the opportunity to really cut our teeth and prove that we had something unique and differentiated in this space. And really, the risk management piece, it created an avenue for us to demonstrate our ability to manage risk in a market that went straight down. So one of the big tenets that we really believe is that our objective is to ensure that we compound investor capital. We're not trying to do that at a rate that is ridiculous. We don't trade with leverage. We don't want to lose investor capital, right? I think we've seen a lot of funds in this space who post incredible returns, and then in one of the tail events that aren't really tail events in this space because they happen all too frequently, they blow the funds up. And I think that, it's great to post incredible returns. It's great for LPs, but it's all timing. If you post incredible returns and then you get blown up in a tail event, it's not particularly helpful for anybody. So our objective has been, how do we provide the best risk-adjusted return for our investors? And so a big part of that for us has been, how do we monitor that risk that exists in this space? And we think about that in a couple of different ways. The first is really just market risk. Like, is there liquidity in the markets that we're trading? Can we get in and out of the positions that we're trading? And can we do that with predictable execution costs? A big part of what we do is predicting entry and exits into markets and having an understanding of what it's going to cost to do that. And so we've built a lot of tooling that actively monitors liquidity in the markets and determines effectively when there are oddities happening or abnormalities are happening with that liquidity. And that helps us identify periods of time where maybe we shouldn't be in the markets, or maybe we need to change effectively the positioning of a portfolio based on what's happening. And March 12th was a great example of that. Liquidity dried up sort of hours before the markets fell apart. And we were able to identify that with some of our tooling and with the relationships that we have in the space. And that helped us, benefited us in a great way that particular day. So that's one piece. The second piece then is around sort of how long does it take to get out of positions? The liquidity in these markets are pretty fascinating. You'll see a lot of funds, particularly those that trade smaller cap coins, like they can post very significant paper gains. But the reality is if you go to manifest those or realize those, you're unable to, because there's not enough liquidity in the markets to get your capital out. And so we track that very, very carefully. All the positions within our portfolio are tracked against average daily traded volume, and we discount that traded volume. And then we take a look at our holdings relative to that discounted rate and figure out how long it would take us to get out of a position in entirety. And we monitor that again for abnormalities. So those two pieces help us kind of on the market risk side. Then we've got a whole other set of risks in this space around technology that you don't have in traditional equities, right? Like this is liquid angel investing in the realest of ways. And the assets that we're trading, they have technology risk where they're emerging new platforms, and failure of those platforms is entirely possible. So you see things like the Etsy 51% attacks, or you see things like the Bitcoin Cash forks that happen pretty consistently. We also see things like hash rate, manipulating hash rate to the benefit of difficulty adjustment. So Bitcoin Cash is notorious for this, where the mining community will effectively stop mining the network for periods of time, and blocks stop propagating during those periods of time in order to be able to reduce the difficulty on the network, thus increase the reward. And so we have spent energy sort of building technology and paying attention to those pieces so that we don't get stuck in markets that aren't functional. Like if the blockchain isn't working, you can't trade it. You can't move your capital around. And so it's effectively, you have a zero on your balance sheet for that particular asset until the technology becomes available again.
Yeah, and I'm sure all those all sound really helpful, and those are innovations in the space that I haven't seen from a lot of the other funds that I'm talking to, the way you guys approach the market. And, speaking of how you approach the market, I heard that you have a new product dropping soon. What can you tell us about that?
Yeah, so we're an actively managed fund today. We move in and out of positions. We go long, short based on what we believe is happening in the market. And structurally, we think this is the best way to trade these markets. If you look at multiple market cycles, we think active management can provide the best risk-adjusted return. Mm-hmm. That said, when we go try to sell new investors into the vehicles that we operate, we have a two-part sale, right? We have to say, hey, here are digital assets, and here's why they're a compelling and interesting investment. And by the way, here's why active management makes sense. And most of the prospects that we're talking with are new to this space. They were not here in 2017. They did not live 2018, 2019. And so they've not been through a full market cycle yet. And it's not until you experience a 70 or 80% drawdown that you really begin to appreciate this notion of active management, that reducing risk through market cycles can be really beneficial. So a lot of the market participants that we're seeing right now, or potentially new market participants that we're seeing right now, really are just interested in indexed exposure. They say, I want access to the space. I want more than just Bitcoin, because I think Bitcoin's interesting, but I think there's a lot here, and I have no idea what to buy. I don't know what Ethereum is. I don't know what Tezos is. I don't know what Bitcoin Cash is or Bitcoin Satoshi Vision. Like all these things are so confusing to anybody on the outside that doesn't have 3 or 4 months to spend full-time researching it all, that is say, I know I want in. How do I do that in the most effective way? And there's really not good products today for everyday people to do that. The products that exist are the grayscale offerings, which are accessible but are very expensive. You're paying premium to NAV, and you're paying extraordinarily high management fees. So that doesn't really feel equitable to new investors, and it's not a great way to introduce people to the space. And the alternatives are index funds like the Bitwise index, which they've raised over $100 million into that vehicle, which is phenomenal, but it's operated as a hedge fund. And there's nothing wrong with that. It just means it's a hedge fund. So there's an 80 to 100 page private placement memorandum, and it excludes anybody that's not an accredited investor. And it's just a confusing vehicle to gain entry or exit to. So we looked at that and we said, there's got to be an opportunity here to build index funds that are approachable to everyday people, whether it's sort of the high net worth person down the street that just wants an easy path into the space, or the retail investor that wants easy exposure that's beyond just a single coin. And so we've been working on a product behind the scenes that provides exactly that. Through separately managed accounts, we're able to offer a basket of different model portfolios. So people can choose between vehicles like a 50-50 Bitcoin Paxos Gold portfolio that's rebalanced quarterly, or a top 10 market cap weighted portfolio. But we also have the ability to do more sophisticated things like a simple trend following portfolio that rebalances based on changes in trends. So you can provide a little bit more active management into these vehicles without all of the overhead and complexity of doing that inside of a traditional fund vehicle. And so we think it's a really compelling way for people to gain access to the space that otherwise wouldn't normally be here because it's complicated, and to do it in a digitally native way. So you can think of it sort of like Wealthfront for crypto or Betterment for crypto. How do we bring that digitally native experience that has become so familiar in the traditional finance world to the digital asset world?
That's really cool. Do you have like a time frame or any idea when that when these might come to market?
Yeah, the products in development right now, we're pretty close to the initial MVP on the technology side, and then the long pole is registration with the SEC. So that will be the determinant. We're shooting for Q1 of next year. That's the objective.
Never want to rush the regulators, though. For sure.
That's right. I mean, we're thrilled. At the end of the day, regulation in this space is one of the most challenging pieces because it's so opaque, right? The rule sets aren't clean or clear, and we've had issues with that going back to 2018 when we started the company, just trying to understand how we fit into the broader landscape and having to work with state and federal regulators. What we're excited about here is that we believe we found a clean path to do this in a regulated way with the SEC, which is pretty exciting. I think there's plenty of other options. You can go buy sort of services that will do this using API keys on top of your Coinbase account or other pieces like that. But for people that are new to this space, they don't want to figure out Coinbase and then API keys and all these pieces. They just want to know that this is an SEC registered investment advisor. They have separately managed accounts. It's done in a safe custodial way, and they don't have to understand all the nuances and complexity of all the different assets in the space. And so we think we've really nailed the sort of trifecta of criteria there.
I think it all goes back to what Steve Jobs said about the first iPhone. It just works.
Right, exactly.
You guys, you have a really interesting way of, a really compelling way, rather, of looking at the markets. And some of your research I've found is really fascinating. One of my favorite pieces written recently was yours comparing digital assets to frontier markets. The regulatory environment and the well-documented bad actors. The lack of correlation really to traditional markets for most of the time, and the low signal and noise there, I think, were really good, high level points there. Would you be able to share a little bit more about that thesis and why it matters, I guess, especially as the markets have behaved as they have over the past few weeks?
Yeah, absolutely. At the end of the day, I mean, whether it's frontier markets or liquid angel investing, we think about this as an opportunity for everyday people to gain access to an asset class that behaves in a way that sort of no other asset class behaves today. With that comes a lot of challenges. So the regulatory oversight piece is a big one. These markets, there's no clarity to how these assets are treated. States treat them differently from other states. States treat them differently from the federal government in the United States. Different countries around the world treat them all differently. I mean, the hallmark of 2017 was which country was going to ban Bitcoin sort of which week, right?
Regulatory arbitrage.
Yeah. So, and we'll know we're back into a bull market when those articles start coming back out again. So that's a challenge for anybody trying to operate in this space. And I think it's been a big it's been a big reason we haven't seen institutional capital enter the space until recently, because there wasn't clarity for how they could participate in a way that would appease the regulatory bodies that they have to participate with. And so the fact that that exists creates that opportunity for everyday people. The fact that you and I and anybody else can get into these markets ahead of regulated entities, really it's the first time there's been an asset class that's been the case. So that creates interesting opportunities. With that then comes this challenge of all these bad actors, and the blockchain space and Bitcoin in particular has become sort of historically synonymous with Silk Road, with drug trafficking, with internet ransom. And I think if you talk to a lot of people that aren't familiar with the space, that's the first thing that they'll say, like, oh, isn't that the money you use to buy drugs on the internet? And so the challenge is that we've seen so much fraud, like outright fraud or theft or hacks in the industry, that it creates this challenging landscape where you have to really become diligent and thoughtful around where you deploy your capital. Exchanges can be risky, but they also can be one of the safer places to hold capital. So it creates this challenging evaluation framework that if you're not in this every day, it's very difficult for people to sort of understand what that landscape looks like. And then the last piece is really to touch on that liquidity piece. And we talked about it a little bit earlier, but liquidity here is such a challenging component to this asset class. Really, once you start moving outside of the top 10 assets by market cap, liquidity can be non-existent for material sums of capital, right? Bitcoin obviously is incredibly liquid. And we've seen that over the last month or two. As you've seen MicroStrategy buy hundreds of millions of dollars of Bitcoin. You've seen Grayscale buy billions of dollars of Bitcoin. We can move in and out of very large positions of Bitcoin with incredibly inexpensive execution costs. And we've grown accustomed to that. And it's gotten much better over time. But once you move out of that top 10, your execution costs, even for inconsequential sums of capital, really start to grow exponentially. So if you're talking $250,000 of notional value put into something in sort of say the 30 to 50 range in market cap, you're looking at 300 to 400 basis points of execution just to get in. And if you're trying to get out in the midst of a market movement, that can go up to 1,000 basis points of execution. And so it really becomes this challenging proposition to think about how do you time the markets appropriately when you're moving in and out of these things. And for a lot of funds, that can be fine because they're going to make speculative long-term bets on these particular tokens, and they'll build a position over time and then exit a position over time. But you have to have belief that to exit a position over time, there are buyers to take that liquidity off your books. And that doesn't always exist. So they're all just really challenging components to pay attention to. And quite frankly, they're components that I didn't necessarily think about when I was personally exploring the space in 2017 or when we launched the vehicle in 2018. They're elements that you begin to figure out just being involved in the day-to-day basis and the day-to-day reality that is this space.
One interesting point you brought up, or one compelling point you brought up earlier, was the fact that you spent the bulk of the 2017 boom conducting a lot of research for IBM. And I'm curious what differences you see between that last run up and this run up, just being given how involved you are, you've been on both sides of it.
Yeah, we talk about that a lot internally. This fundamentally feels very different than 2017 for a number of reasons. First off, I think 2017, so much of market movement and price action that year was dictated by the ICO and sort of the insane valuations that these ICOs were creating, and this whole sort of intrinsic cycle where gains in an ICO would be sold and then redeployed in another ICO. And most of that was being participated in by retail investors. And it was retail investors that largely got burned as that bubble popped. And most of those ICOs didn't have functional products, right? They were ideas. Fast forward to today, most of the assets that are appreciating in value are functional products in the market. They're doing something. You look at the whole DeFi space, those aren't ideas, they're functional contracts. And whether or not they're worth what they're valued at today, like let the market decide that. There's actually something there to value. There's something you can use and touch and feel and interact with. That's so structurally different than what we were seeing in 2017. The second piece, again, I think is the institutional access. So we've now built this regulatory clarity where large institutional investors are comfortable now participating in the space. Skybridge last week was another great example, right? You have a multi-billion-dollar manager filing with the SEC saying they're going to participate in the space. They're doing that because they have comfort that the regulators will be okay with that. And that was not something we had in 2017, right? In 2017, again, it was when's the next country going to ban this asset class? It's when's the federal government not going to be comfortable with the way this is behaving anymore? And so that I think really changes the game. A lot of the retail investors that were burned, I don't think have necessarily come back yet. And I'm not sure they will until we sort of get back towards that all-time high, which is unfortunately sort of, they're late, right? It's funny, we talk often that Bitcoin at $4,000 was a lot less attractive to market participants than Bitcoin at $18,000. Like, people want in now, they didn't want in at $4,000. And it's just this weird psychology that exists here that sort of unfortunately punishes those who waited. So we'll have to see. We'll have to see. I mean, this feels so different than 2017. We'll have to see if it plays out.
I do. I agree with you 100%, Jesse. I mean, just from the institutional aspect, the playing field is occupied by different participants now. You mentioned the ICO craze, and now it's a bunch of retail hype, but now you have a lot more rationale behind the market. So from a capital market standpoint, regardless of things that have, proper use cases now and things as such, you have rationale behind strategic trading. You have professional institutional market makers. I mean, you have all the components from the adult table now filling in the space that I feel that the price action is more fundamental than it was. I mean, far more than it was in 2017.
Well, 2017, it's like, why did you buy that particular coin? Well, because it's going to go up. It's like there was no thought, there was no consideration. You just bought something because it was either going up at an insane rate or it was going to go up at an insane rate. And you found it very difficult to find investors that could articulate why they bought something then. And now almost everybody can articulate why they're in a position. And I struggle to believe that there's fundamental value in any of these assets, but I do believe that people have sort of built their own thesis that they believe, or I should say, there's not shared fundamental value. There aren't shared valuation models for these assets. So you can't go, and we can't necessarily point to a specific valuation model and say this asset is overpriced or underpriced because we agree on these characteristics. Everybody has their own thesis, but those theses are actually rooted in some form of reality or fact now, where before it was just hope and dreams.
I like to call it synthetic fundamentals, right? So you take Bitcoin, for example, and there isn't anything tangible with Bitcoin. If you sold all the pencils and desks in Bitcoin, there's no, hard cost value. But what you do get is that synthetic fundamentals, which is, hey, is this a deflationary or inflationary hedge or play? I mean, so from that regard, and the way Bitcoin has kind of, created its own theories, I think that's exactly, to your point, what it is now. And that's a trickle down effect, right? So just like DeFi to Ethereum, why does it, if people who participate in Ethereum, they get the value derived from the DeFi market now, and there's a use case for it, and so forth and so on. I think that's part of the excitement and the growth of the market. And then, of course, the challenge is, how do you trade around that, right? What are the ups and what are the downs? So,
and people can articulate it, right? I think that's the fundamental difference. People can articulate why they believe these assets are worth something, and that is structurally different from 2017.
That's why they call them like armies or Marines, behind the coin name. The hedge fund business as a whole is a mystical place for people on the outside of it. And then crypto funds even more so. to the traditional hedge fund manager looking in. Are there any particular aspects that you can tell us about Strix Leviathan that might lift up the curtain? Is there anything in your Form Ds, or do you have any investors you can name, or can you give any of the people out there like some insights into underneath the veil, so to speak?
Yeah, absolutely. It's interesting. I mean, there's certainly a lot of regulatory restrictions that prevent fund managers from talking about pieces. But at the end of the day, our clients are largely high net worth individuals and family offices. They are, I would say, they skew towards the younger generation. They're people that are curious about this technology. They want to learn, they want the exposure, but they don't necessarily have time to do that in their own daily lives because they're busy with their own businesses or their jobs or their families. And so they have elected to work with an entity like ours because we are in it every day and because we can share those learnings and that knowledge back with them. So it's sort of a two-way street. We feel very blessed to be working with sort of a host of notable investors, and Joe Montana is probably the most public one. He's been able to publicly go on the record for us as an LP, both an equity investor and an LP. And so we're honored to have him participate in the vehicle. We have other professional sports players in the vehicle as well. It's all over the map. But at the end of the day, every investor has effectively wrote the check because they wanted to learn more and they wanted to grow their knowledge about the space.
It's almost like they're buying an education into it, and I think down the road they're going to be the really successful ones as an investor because they did that, right? You always hear the phrase, "We're still early to this," and I think that plays true. Let me ask you this. I mean, I know Matt Heater from your firm over the last couple of years and stuff like that. So you have a person who does investor relations and business development. What would you say is the map of the sales cycle for an investor from when you first touch them to when they either decide to subscribe or they don't? But what is the process? Is there like, okay, the first it takes approximately this long. The first part of it is education. The second part is what? And the third part is what?
Yeah. I would say there's two buckets here. We have a set of investors that come in very warm, oftentimes from existing referrals from existing LPs, and they're just excited about the space. They want a little education about how we approach this asset class, why that's unique and differentiated, why we believe it's sustainable, the methodologies that we use, et cetera. And that they're often very quick to move. That cycle is often 1 to 3 months worth of time frame. Then there's the other side, which is sort of the net new investor that we've never spoke with before. That may have come in off the website or heard us speak on a podcast or found one of our research pieces. That's a much longer sales cycle. That's typically, and again, a lot of these are more sophisticated allocators, right? They may be a fund-to-fund vehicle. They may be a family office that is used to allocating to different hedge fund processes. And so the diligence there is often much deeper than an individual may do, rightfully so. And so we may spend sort of a month or two getting to know the individual allocator, explaining the thesis of the fund, the who we are, why we think we're qualified to do this, sort of the objective of the fund, how we achieve that, what the expectations for the fund should be, and then sort of the education or experiences we've obtained over the last 3 years and how that benefits an LP moving forward. All of those are sort of part of phase one. Phase two is more that institutional due diligence process. So we've got a huge due diligence questionnaire that we've compiled over the last 3 years that must span 100, 200 pages of content that covers any and everything about the vehicle. Includes audited financials and operational practices and capital controls and custodial risks and sort of any and everything that you want to know about how do you effectively operate a fund in this space and how do you do it in a safe and reasonable way. So that review often can take a month or two in its own right, kind of going back and forth and answering questions. And then the final piece is capital allocation. So once we've sort of completed all those pieces, oftentimes, and particularly on the fund-to-fund vehicles, they may not have capital ready to allocate at that particular moment in time. And so they're fundraising in their own right from external investors. And so we wait for them to have capital to be able to deploy and allocate. So those cycles, they can go from 4 months to 6, 9, 12 months on the outset. And again, a lot of it, like we have investors that have committed to the vehicle that like recently that we were communicating with from day one. So a lot of it is just appetite over time and really being regular with communication and with that reporting and with the research that we're able to produce and share.
Sorry to cut you off.
Yeah, good.
Have you seen an uptick in inbound interest as the markets have performed better, or has that remained relatively similar to where it was when the market kind of?
Jesse, it's what you said, right? Everybody likes Bitcoin at 18,000. Nobody liked it at 4,000, right?
Yeah. I mean, so we definitely, anytime the markets move in the way they're moving now, we see an uptick in interest. January, February, we saw a huge uptick in interest. And then March happened. And between the traditional financial markets and the crypto markets, that really decimated all interest in the space. And then that picked back up, call it September, October, and then started going in November. So absolutely, I think if you took the chart of Bitcoin's price and you mapped it against interest, it's going to follow very similarly.
Fair enough.
Well, all the peaks are when the subscription comes in, right?
Right, exactly.
Jesse, I really do thank you. It's been no lie, guys. It's been like 3 months now trying to get them on to speak about it. Strix Leviathan is one of the most transparent funds out there, as you just, heard. They'll talk about just about everything that they legally can in the crypto space about their fund, and that provides a lot of insight. And transparency does equal trust. That is one thing for sure in this space. All their stuff will be in the description, how you can contact them. Jesse, Matt, the guys at the firm are readily available to speak about anything crypto fund related when it comes to investing in the space in their vehicle. Also, you guys just put out, actually, I believe today, a new blog post, right?
Yep, absolutely. So we have an investor portal that all of our LPs have access to. Historically has given them access to sort of stats on the performance and statements, sort of everything they would need. We recently, this month, added a performance report that is published every month that gives investors transparency and visibility into what the fund did in the previous month. So allocations over time, so allocations at month end, where we made our money, where we lost money in the month. All of that is visible in the report. And we've published a blog post with some sample data that really talks about that. And again, it goes back to this objective of really being sort of the most transparent fund in the space. We think this entire asset class was built on this notion of blockchain being a transparent mechanism to be able to track transactions, and yet that transparency is really absent from most market participants, and we think it's time that changes. So we're really excited to publish this feature, and we received great feedback so far from existing investors.
Yeah, and do you guys have a public distribution list, a newsletter that's a regular occurrence by any chance?
We have a list. You need to be an accredited or qualified purchaser to receive it. So you can fill out a form on our website to sign up for that.
Perfect. All that information will be in the description, guys. Definitely take a look. One of the more professional crypto hedge funds in the space, and in crypto terms, one of the OGs in the crypto fund space too. So, Jesse, thank you very much again. Really appreciate it. And I look forward to catching up again in the near future.
Absolutely. Really appreciate taking the time.
All right, guys.